Stocks taking a breather from the post-election pop, but the major averages in a number of sectors are still up nearly 5% or more just this month. So has the rally gotten ahead of itself, or is there more runway ahead? Let's ask Sherry Paul of Morgan Stanley Private Wealth. Sherry, good to see you.
Great to see you.
So you have to operate where the long term and the short term kind of come together and figure out what has changed and what hasn't, maybe, when it comes to things like, this new policy push or anything else. What are your sort of top line thoughts at this point?
First of all, thank you for having me. My top line thoughts are that when it comes to investing, not a whole lot has changed, because my strong recommendation to clients right now is to invest in enduring themes that are earnings driven, that transcend presidential or policy politics. So those themes continue to be intact. They drove the market this year. They drove the market last year. They'll continue into 2025. Centered on AI thematics, which we can get into a little bit more. With regard to policy, though, we're back to policy volatility, and that typically brings 3 to 5% swings in a market as the conversation around what might happen continues to accelerate. But what we know about policy, even if the Republicans have a triple crown, it usually means that there'll be a lot of talk and all of a sudden there'll be a decision day. So we're hedging that, but we're not necessarily investing in those outcomes, because those are conversations, they're not earnings based.
Now, when you mentioned the longer term themes that you think remain on course, like the AI investment theme, I can imagine a world, if we didn't happen to have an election this year, to where maybe there'd be a little bit of a pretty good debate going on as to whether we've hit some kind of a plateau. I know there was some talk last week about this. Maybe the next generation of ChatGPT is just not, bearing as much fruit in terms of acceleration. And also semiconductors, it's really hit or miss in there. So I just wonder where that particular theme sets up for you right now.
Well, it's a great point. I think where it sits is in the larger conversation around deglobalization, right? So deglobalization, which requires a reimagining of supply chain and onshoring manufacturing, it also disrupts what the human labor composition of globalization was, which can be expensive. And so I really believe that that becomes the accelerant around AI, particularly in automation and manufacturing. Wherever you can replace human labor, you're removing yourself from the geopolitical consequences of those outcomes from a manufacturing standpoint. It reminds me a lot about what happened during the pandemic, where in the pandemic, I think like less than 50% of people in the country had ever deposited a check via their iPhones. And so that became an accelerant of what we invested in at that time, was the remote of everything. Now it's the automation of everything that would position companies for cost reduction, productivity enhancement, and also controlling outcomes in a world that may continue to deglobalize.
It's interesting because if you hear the stated intent of a lot of the policies, it's not just deglobalization, but bring physical manufacturing work back here. And, these very long-lived kind of objectives, not necessarily companies making a decision to just get more efficient or find a way around.
Right. Well, that's what I love about the capital markets, right? Because so again, we go back to enduring themes that actually drive earnings. That's where investors should be. And that's how our portfolios are set up right now. Now, they're reimagining a different sort of U.S.-based manufacturing renaissance. That might be multi-year out. It's also fundamentally inflationary from a cost standpoint to corporations. And so the incentive there then is, wow, if we're going to do that for greater political stability, then we should be pushing automation in a way that can bring about cost savings, and maybe we end up in a balance as it relates to earnings and profitability.
I wonder, I doubt your particular clients would have really had a very sudden change of mood over the last few days, but the market character really did somewhat shift in the direction of got lathered up in some areas, small cap, meme stocks, crypto, a lot of the stuff that moves fast. Tesla seems like it just got this burst of energy into it. And other stuff maybe got, neglected or set aside. Does any of that speak to you in terms of whether risk appetites are rising or if it's just a passing phase?
Well, it's a really good point, because we've got lots of money sitting in cash accounts that are taking pay cuts every time the Fed cuts rates. So if you want a little bit of taste of what FOMO looks like, we got it in the last 7 days. And that just requires a mental shift for people to get out of cash into a market that will likely continue to accelerate.
What about just fixed income as a category? Is it doing its job in a portfolio? Are you not interested in terms of based on what the economy might do?
Yeah, it's hard for people to say, why should I continue to own fixed income? But right now, for us, it's an airbag in a portfolio. That's really how we describe it to clients. And so if you're extending out, it's not too late to extend out, especially when you get the bumps in yields like we did over this concern around inflations associated with tariff policy, which sort of drove the 10-year up. But if you're extending out in that 5 to 7 year range, you should get a nice little pay bump in terms of price appreciation as rates continue to go lower, and you're locking in good income. That provides an income hedge to the innovation trade, which just by nature will bring more volatility to a portfolio, which is different than something going wrong. That is the key for people. Is that volatility will start to spike. It doesn't mean that things are going wrong.
It's interesting you say that. I was just pointing out yesterday, if you looked at the second half of the 90s, it was actually a pretty volatile market. And the VIX never really went below 20, and yet markets were going up, and it was capitalizing a lot of the new innovation.
Right, because we were in the front end of the innovation, right? Because volatility, this is innovation volatility. That's different than, oh, wow, things are breaking volatility.
Sure.
So a reset is not a recession. And a reset is not necessarily a correction. It's just a reset sometimes.
Yeah. See if we get one of those soon, Sherry. Good to see you. Thank you.
Thank you.
All right.